Welcome to The Critique. We're looking at a piece on the recent surge of global bank investment into India, focusing on deals like Emirates NBD's stake in RBL Bank.
And it's a solid piece of work. The framework is there, it's got the drivers, the current situation, what to watch. It's robust.
It is. So we're going to dive right in, because the foundations are excellent, and we see some big opportunities to add a new layer of strategic depth.
I agree, it's already operating at a high level, but we want to make sure every systemic part of that market is really baked into the core thesis, not just tacked on at the end.
Okay, let's start with that idea. Our first opportunity is all about factoring in systemic risk.
While the material effectively lists historical risk elements, integrating these challenges proactively into the core analysis of investment strategy would significantly deepen the commentary.
That's a great point. So the material flags things like risk elements, integration, compliance, local competition, and the big one, asset quality issues.
Right.
And it puts them under the what to watch section, which, seems intuitive. If they're risks, you watch for them. But what's the actual danger in placing them there?
The danger is one of analytical minimization. The weakness is that you're treating these really well-known historical struggles, like massive asset quality issues.
The NPAs, the non-performing assets.
Exactly, the NPAs. You're treating them merely as a future risk to watch. And it minimizes their importance. These aren't some unknown future threat.
They're a baked-in feature of the system.
They're an enduring systemic challenge. I mean, if you look at India's banking history, NPAs have defined whole periods of financial stress. A sophisticated global investor isn't thinking, if this becomes a problem.
No, they're thinking, how do we deal with this problem right now?
Right now. It has to be factored into the valuation, into the deal structuring from day one. So when you position it as just a reactive watch point, you're sort of obscuring the huge calculated risk that's already part of this $8 billion surge.
That is a crucial distinction. It implies these global banks are going in with their eyes wide open. So if they are mitigating this risk immediately, what does that tell us about the kinds of banks they're targeting?
It tells us they have a filter.
A filter for what? Clean balance sheets? Or something else?
It means they're not just buying the vague idea of India's growth. They're making a calculated bet on specific targets that either have cleaner books already or, and this is key, offer the kind of governance structure where they believe they can fix the issues fast. So the suggestion here is a structural one. You need to shift the analysis to incorporate these risks not as future hurdles, but as filters.
As part of the current investment thesis.
Exactly. We need to analyze how these banks are managing the known risks. What are the mechanics of their calculated risk-taking? It means explaining why a certain target is chosen over another.
So the discussion shifts from risk exists to risk is being priced and actively managed. Which of course it is. That $8 billion has to be deployed in a way that shields it from those NPAs.
Precisely. If a bank is known for asset quality issues, a foreign capital injection has to be incredibly strategic. It can't just be a general boost to the balance sheet.
Right, but getting into deal structuring, that can require non-public data. Are we suggesting the analysis needs to dig into public filings, or is this more about inferring the strategic priorities?
It's more about inference based on logical strategy. You can use what we know to make a strong hypothesis. For instance, instead of just listing asset quality issues as a risk,
you analyze the deal itself.
Yes. You analyze how the current deal terms, like the RBL Bank stake, probably reflect some built-in mitigation strategies against those historical NPAs.
So were we talking about analyzing if the capital is specifically earmarked for cleanup? Like, these funds are restricted to just repairing the balance sheet?
That's one way, but there's probably a more sophisticated angle. Remember, the drivers section mentions Indian banks need capital and operational upgrades.
Okay.
So if a global bank is laser-focused on risk, they might prioritize pouring that capital into, say, cutting-edge underwriting technology.
Oh, like AI-driven risk assessment tools?
Exactly. Something designed to dramatically improve the quality of future credit, rather than just mopping up old debt. That shows how the risk directly influences the structure of the deal. It becomes an investment in process, not just a palliative. And that reveals a real long-term calculation against a known systemic issue.
That completely transforms the risk section. It goes from a passive checklist to an active, strategic part of the assessment. It shows the reader what investors are actually doing today to face those historic challenges. That's very actionable. Okay, let's move to the second major point. This one is about bringing more clarity to the regulatory picture. There's a subtle but important overlap in the text right now that we should probably untangle.
Absolutely. To maximize clarity, the analysis should draw a sharper analytical distinction between investments leveraging existing private sector freedom and those waiting for the major regulatory reviews concerning state-run banks.
Right. As I understand it from the material, it correctly identifies that policy gap. Private banks allow up to about 74% foreign investment, but public, state-run banks are way more restricted.
And the government wants to close that gap, yes.
So where does the confusion start to creep in for the reader?
It's a question of timing and targets. The weakness is that the piece cites the Emirates NBD deal, which is a perfect example of that $8 billion flow into the private sector, and then immediately starts discussing regulatory changes for
everyone else.
Right, for the 15% shareholding limit for non-government lenders, and then the really tricky restrictions on the public state-run banks.
So you have three different regulatory dials being discussed at once, and they're not all driving the current surge equally. By putting them all together, you might lead the reader to think this $8 billion is happening because of changes that haven't actually happened yet.
Precisely. That juxtaposition creates a kind of analytical noise. It could easily confuse a reader about which regulations are driving the money flowing in now versus which ones might trigger the next wave.
And the next wave could be much bigger.
Much bigger. The current surge is fundamentally about banks capitalizing on freedoms that already exist in the private sector.
That makes a lot of sense. The current activity is based on existing stability and openness. The proposed changes are about future opportunity, and that requires political alignment.
Which is why the suggestion is to create a very clear separation in the narrative. Maybe frame it as a phased investment model.
Okay, so a phase 1 and a phase 2.
Exactly. Use the RBL example to strongly illustrate phase 1 investment that's capitalizing on that established 74% limit in private banks. These are the low-friction deals. Then position the upcoming reviews, especially for state-run banks, as the strategic next frontier.
That next frontier framing is a huge distinction, isn't it? Because it's so tied to political will. A private bank deal is largely transactional. An acquisition of a state-run bank it's structural, it's political, it could come with a lot of nationalistic baggage.
That is the core insight to get across. Phase 2 is about unlocking a whole new class of assets, massive ones that are basically inaccessible right now. And you need to highlight that the political risk involved in, say, privatizing a state-run bank is orders of magnitude higher.
Which explains why phase 2 hasn't happened yet.
And why, if it does happen, it'll be seen as a sign of much deeper liberalization.
So we should make that political element, the regulatory uncertainty itself, part of the analysis of phase 2, instead of just treating it like a standard policy update.
Yes, explicitly refine that policy gap narrowing section. A concrete way to do it is with sentence structure. Frame current deals as phase 1 investments, the quick-to-market ones. Then position the proposed cap increases for state-run banks as a political trigger for phase 2.
This helps the reader understand the timeline.
Immensely. It clarifies that the current $8 billion is probably targeting one set of criteria, while the next huge wave depends on major political decisions about sovereign assets.
That's fantastic. It gives the regulatory story a defined phased impact. Phase 1 is about speed and existing opportunity. Phase 2 is about strategic patience and political leverage. Okay, our third and final opportunity looks at how we project future growth strategy beyond just, core banking.
The forward-looking element regarding spillover into adjacent financial services should transition from asking if it will happen to analyzing why it is a logical, inevitable next step in the investment strategy.
I see where you're going. The material asks under what to watch whether foreign capital will flow into other areas like NBFCs, fintech, payments. Why is framing that as a question understating the case?
Because you have to look back at the foundational drivers that the piece has already established so well.
The large underbanked population, the need for operational upgrades, and high potential for digital adoption.
Exactly. The weakness is at framing the spillover as just an open question. It actually undercuts those very strong drivers you just listed.
Right. If your goal is massive scale and you want to reach that huge underbanked population fast, a traditional branch network is the wrong tool. It's too slow. You can't wait 20 years to build a physical presence.
You can't. So, given those factors, investment in complementary sectors like fintech and payments seems less like a possibility and more like a strategic necessity. You have to do it to maximize your return.
They're not just buying a bank's equity, they're buying access to the Indian consumer growth story.
And that story is increasingly digital first, so the suggestion is basically to assert its inevitability. If they don't invest in fintech, they risk their new banking asset being totally isolated from the fastest growing parts of the financial ecosystem. They'll fail to capture that massive digital demographic.
That's the strategic assertion we need. To reframe the analysis and just state that investing in these adjacent sectors is a necessity for any global bank that wants high returns and large-scale entry.
The reality is that traditional banking infrastructure is just too slow, too insufficient to serve the underbanked population and get the digital scale you need for rapid market penetration and cross-selling.
So that raises a critical question then. If they do invest heavily in fintech, are they positioning themselves to compete with all the local fintech unicorns? Or is it more of an accelerator for their newly acquired bank?
It has to be the latter. That's why we call it a spillover effect. It's tied to those operational upgrades we talked about. It's not a separate venture capital play. Global banks want an integrated approach where the new bank leverages adjacent tech for efficiency and reach.
Okay.
And we can make this connection much sharper with some concrete examples. You can link the growth quest driver directly to NBFCs and fintech.
Can you give us an example that really clarifies the different functions of those investments?
Certainly. You could explain that an investment might target a specialized NBFC, a non-banking financial company, specifically to capture a niche lending market. Something like asset financing or gold loans, which foreign banks can't easily access with a normal branch network.
So that's a targeted distribution play.
It is, using established local infrastructure. And then conversely, you'd say they should prioritize fintech platforms to instantly leverage India's high digital adoption for payments and transfers. This isn't just about speed, it ties directly back to that driver about needing operational upgrades.
Why rebuild an entire payment system from scratch?
When you can acquire one that's already functional and widely adopted. This shift in framing shows how the current investment in a bank is really just the entry point to a much broader, digitally enabled ecosystem play. And it's all driven by strategic necessity.
That's a much more robust conclusion. It ensures the analysis doesn't just stop at the bank itself, but looks at the full scope of financial modernization required to win in that market. So, to quickly recap the three key opportunities we've identified. First, we said to transform the discussion on systemic risks like NPAs from just a watch factor into a proactive analysis of deal structuring and risk mitigation.
Right.
Then, second, clarify the current deals versus the next regulatory frontier by setting up a clear Phase 1 for private sector access and a Phase 2 for state-run bank access.
And finally, sharpening that forward-looking analysis on the spillover into fintech and NBFCs, treating them not as maybes, but as strategic necessities needed to achieve scale and digital penetration in the Indian market.
The underlying work here is very strong. It's well-cited, it's comprehensive, but focusing on integrating the how and the why of risk management and that regulatory differentiation, that's what will transform it.
It moves it from an excellent summary into a deeply robust strategic document.
You have a clear path forward to really maximize its impact, and we are looking forward to seeing the revised work soon.
Thank you for sharing your material with us.